to call this regular meeting of the Board of Finance to order for Tuesday, March 17th, 2020. Appreciate everyone coming today. So we're under some extraordinary circumstances. Joining us here in person today is Paul, Jim, myself, Dan, and Rob. On the phone is Frank Huck and Taylor Carter, so we have them dialed in on a conference call, and hopefully the audio comes through so that everyone will be able to hear them. So just a couple of comments to start off. As I said, these are extraordinary circumstances. You've likely read in the press where Jamie Stevenson, our first selectman, has declared a state of emergency for the town, which puts us all on, I think, a serious footing to deal with this, and means that we need to do everything we can locally to support efforts to fight this virus. My urging would be that we all follow the guidelines that are set out by the first selectman as well as by the state of Connecticut and the federal government. And our medical professionals are the ones who know what they're doing, and we should do as much as possible as we can to cooperate with them. At the same time, we have to function as a society and as a town. And as much as we all need to stay home to follow all these guidelines, we need to keep in mind that there are a lot of service businesses, a lot of face-to-face businesses in the town that depend on face-to-face traffic in order to survive economically. And in a state of emergency like this, those businesses are under extraordinary pressure, and that pressure is going to get worse. And so I think collectively we need to be supportive of them. I know there are some town efforts underway, or at least some discussions to ponder what we might do to be supportive. But the reality is that we're sitting at home, and the great thing is we have internet access, we have computers, we have PayPal, we have online credit cards. And so there are ways to spend money in local businesses while you are sitting at home. And so if you think of it and think of ways to do that, whether it's ordering something online or by phone from a local restaurant to have dinner. A lot of these restaurants are gearing up to try and offer takeout service, even though the restaurants themselves can't take patrons. I would urge everyone to do that. Anything you can do to spend some money on our local businesses, ensure that they weather the crisis just like we're trying to weather the crisis ourselves. And also further ensures that when we come out of this on the other side, and we will come through this, but when we get there, the businesses that we come to depend on in this town, and the ones that, frankly, we love, and that we've spent so much time trying to support and build up over the years in a way that makes Darien a unique town, that those businesses will be there for us when we come through this. So keep them in mind and spend your money on local businesses in whatever creative way you can possibly come up with, but let's help them get through this crisis as well as ourselves. So those were my comments. We're going to abbreviate our agenda this evening to focus on some critical things. First thing I want to discuss is the discussing and taking action on the proposed bond sale. We have on the phone our bond counsel, Mark Chapman, who's going to help us with this, and Jennifer, who is also here, can chime in as well. Jennifer, you want to kick this off? I know Jim will have something to say as well, and let's see if we can get through this.
Sure. What we are looking to do is tee up everything that we need in order to do a new issue as well as a refunding when market conditions are right. So you have before you some revised resolutions to sell for the new money as well as for the refunding. For the new money, a couple things that we need to figure out is how much do we want to issue for Ox Ridge, what structure do we want to do, and given what's going on in the world and the fact that this is combined with a refunding, normally we'd do competitive sale for a new issue, but do we want to consider a negotiated sale? So Mark has come up with the pro formas based on, so I want to take a look at the new issue first, start with looking at how much we want to do for Ox Ridge. You have their cash flow projection in front of you. If they proceed as planned, they'll need about $20 million for the next 12 to 18 months. If we want to do more than that, they'll use about $40 million in the next 2 years. So Mark has put together pro formas that look at those two scenarios of either 20 million or 40 million and maximum deferral of principal level debt versus level principal. So I can turn it over to Mark and he can talk about the scenarios a little bit.
Okay, thank you, Jennifer. Mark, we've got the four scenarios that you've prepared for us, one at the $21 million level, the other at the $41 million, and then the two scenarios for each around maximum deferral of principal to achieve level debt service, and then 2020, the new 2020 bonds level principal payments and then max deferral on the rest of the debt structure. So would you like to take us through those scenarios and let us know what you think?
Sure. So, in looking at this in regards to your cash flow, I mean, really, I guess that's going to drive the bus, so to speak. So whatever your needs are, that's what I would kind of focus on what amounts you should be borrowing. But in regards to the different scenarios, so if we're looking at, and it all depends on what you're trying to accomplish. If we do the level principal, which the town has historically done prior to the last deal, I believe, it does save you overall interest. But if you do the max deferral with the level principal and interest after that, it does. Obviously, it costs more in interest expense, but it also helps us try to get over, kind of those peaks in maybe in fiscal 23. So kind of softens the blow a little bit when you're looking at those years. What kind of throws this off a little bit is in 21, with the cash defeasance you did last year in November, it obviously saved you folks some money for your budget that you're working on now for 21. So it kind of gives us a dip and then a bump back up in 22. And in regards to interest rates on here, these were as good as actually the day before these were printed. The muni market and all markets right now are pretty volatile, and it's kind of hard to keep up with what's going on. If we were to sell today, we would probably be closer to almost where we were last year at this time, right around 2.7% versus 2.25%. Literally we couldn't keep up with the changes that were going on last week in regards to the municipal market or the treasury market or the stock market.
Okay. Jim, questions, comments?
Yeah, I guess maybe just on the new issue, a couple questions I had just related, as we think about the size, do we do 20 million versus 40 million? To the extent that the town and the building committee wasn't to spend the money to meet some of those guidelines that the IRS lays out, is there a penalty, or is there just a little bit of incremental work that we need to do in terms of tracking our investment on those funds?
So I'll clarify that this is your tax. I am not a tax attorney, so just to clarify that aspect of it. I do know enough to be dangerous. In layman's terms, if you are able to arbitrage it, positively arbitrage it, meaning you borrow at 1%, or let's say 1%, and you were able to invest at 2%, and you didn't meet those spend down requirements, you would have to pay the IRS back that interest income. That's kind of the Reader's Digest version of it. If you are, in this market, you're probably not going to meet that threshold, but you are still required to monitor it. And then if the IRS, if you win the lottery and the IRS comes knocking and says, we want to see your calculations on this, and then you would have to hire someone to pull that together for you, if they believe that you in fact were had arbitrage bonds.
Mark, when you say you have to give back that interest income, is it the net amount over your debt cost, or is it the gross amount, meaning all of it?
Honestly, I don't know that. I'm sure it's your income plus penalties, if I know the IRS.
Yeah, I think typically if you borrow at 1
And
And
invest
you
in
can,
two.
you get to deduct certain expenses like your underwriting costs, legal costs and so forth, but if you borrow at 1 and invest at 2, there's a certain amount of time, correct me if I'm wrong, Mark, where you get a little bit of free time, whereas you can actually earn more than your arbitrage yield. But if you don't spend down those requirements, they go back and they say, listen, the amount that you arbitraged, like the difference between the 1 and the 2 is what you need to give back.
Right, the excess between the two.
And then
And,
There's
the excess, so it's the net
percentages.
amount, not the
Right.
gross amount.
I believe Jen had that in the handout. So there's certain thresholds you need to meet by certain timeframes. And once again, I'm not a tax attorney, so that's something, if you need very specific information on that, then we really should call Marie Phelan and get their folks.
Okay.
I don't want to mislead you on that.
Well, Jen and Mark, I guess when we look at the very back of like the 4-page memo where it talks about, what percentage of the bond proceeds we would spend in 18 months if we did 41 million versus 21 million. And this incorporates things like the generator and the elementary school roof and so forth. On the bigger issue one, the 41 million, it says we've spent 79% of the proceeds, and it seemed like the memo suggested that we would need to spend at least 75. So if we were to do the larger one, it seems like we're spending it, by a 4% cushion.
correct. That's the numbers off of their projection. My one concern that I do have right now is if their project slows down because of what's going on, if they can't get to P&Z, if materials aren't available, I don't know how much their project timeline is going to be impacted by that.
Well, one of my questions on that was, in the memo here, it talks about sort of you have to spend the proceeds or have contracted. So this schedule on page 3 and like the percentages on the back, is that the actual dollars that we would spend or the amount that we would have?
Actual expenditure.
So, but does the tax law and do those percentages relate to sort of encumbering?
When I spoke with bond counsel, she mentioned the contracting amount applies to the first 6 months where you must have 10% expended and/or contracted. She did not specifically say if it applies to all the other milestones, but we do expect to have the construction contract in place on Oxbridge, assuming all goes as planned, well before 6 months after this issue.
And then I guess when we look at the two bookends of 21 and 41, could we do 39, 38?
Yeah, you can do
Those are
anything in
just
between. These were
illustrative,
just
right?
for showing the impact of kind of top or bottom.
Okay.
My takeaway, Jim.
How long could we delay? How long could we delay the offering in terms of, focus on that 40? So if we issued 40 today, we'd have the time period. If we issued them in 3 months, we'd have 3 months more, right?
Right,
Effectively.
right, because those milestones start from when we issue.
And I think these percentages right here, then, are these based on like March 11th here, or are they based on the closing date, which is going to be like May 10th or something, I think we assume?
The March 11 data was just because that's when I put it together. That's what we had spent to date. I don't think we've spent anything. We haven't cut any more checks on that
No,
project since
It
then.
means the percentages there under 6 months, is that 13.73% since, is that right?
Yes, since
Yes.
March 11th.
Since March 11th.
So I think
Yes.
to Frank's point, we already have, it sounds like we have a couple months moving from early March to early May to keep us underneath that, put us over the
Over the
75% threshold.
My initial takeaway, subject to
Okay.
what we learned tonight, was the 40 million seemed a little bit aggressive to the timeline, especially considering it's more likely that the construction spending will slow rather than accelerate, given the circumstances. That was kind of my high-level observation.
Yeah. Well, let's say that we get just $21 million. I mean, the reality is unless the whole world collapses, which is another set of problems, our ability to access funding in the marketplace is not going to be impaired, right? As a AAA credit, we're still going to be able to borrow to get the next tranche of 20 million and the tranche of 20 million after that. So I think the question is around how do we feel about the timing of this, right? Are the interest rates such that we would want to do this sooner rather than later, recognizing that, yes, it's low-cost debt, but the reality is we're going to put this in the bank while we wait to spend it. We're not going to earn any money on it because interest rates are low everywhere, right? Versus splitting that up into, say, 3 tranches of $21 million through the end of the project. If you do that, then you've got maybe 3 borrowing instances and the costs associated therewith, as opposed to one $41 million one and one $21 million bonding to kind of wrap all this up. But maybe there's enough refinancing at different times later that we were going to have to borrow anyway, in which case you're going to have the bonding costs at the time we get these subsequent debt issues in any case. I think that there's a real risk that we're going to see a slower pace of construction than we otherwise wanted. I know the building committee is very focused on making sure that doesn't happen in order not to delay the opening of the school. But given all of this, it's hard to imagine that there's not going to be some delay, either in workers available to show up, or frankly, just shipment of raw materials to build the place. I mean, it's highly likely that some of that's going to get delayed.
Well, I think setting logistics aside, I think maybe a couple things we should follow up on is just a couple thoughts here. We should find out what exactly is the penalty if we don't spend the money. Is it simply just an additional calculation? Is it just giving back stuff that we made above our arbitrage yield, which isn't why we're doing this?
Bond counsel said it is the excess earnings that we have to send to the feds.
So then I think it gets back to if we can meet our arbitrage yield, if we can borrow at, let's just say 1.5% and reinvest at 1.5%, then issuing 20 versus 30 versus 40 should just be a decision about how we feel about the rate environment. So
Right, because the net penalty is not going to, it won't be a material in any case.
We're not borrowing 40 million at 2% to try to go out and invest it at 3%. Where
Right.
Generally the IRS doesn't allow you to earn more than you can. So I guess, Mark, when you think about what you're seeing in like short-term escrows, like slugs, like we're going to talk about on the refinancings and other sort of short-term GICs, just given the general flatness of the yield curve right now, what do you think we would expect? I know everything's changing, but what do you think we could expect to earn relative to our arbitrage yield right now with where taxables versus tax exempts are?
Well, you could, if you so wanted to, and assuming we were where we are with interest rates right now, honestly, it's a pure guess. This has been a 2 weeks or a week and a half of pure bliss in the muni market. And I mean all markets, but for us, we don't like, muni guys don't like volatility at all. So, in a perfect world, if you were to do that, you could do, you can invest it in if you had not excess proceeds, but if you had proceeds, you knew you weren't going to meet those, you can invest them in slugs or other things that would be yield restricted, right? I don't think you're going to get there anyways. So to me, it just becomes it's what you believe to be, what do you think we're going to spend? To borrow 40 million now versus whatever the number you decide to go with, and sit on it and not use it, in essence, then you're paying interest back on something you didn't need for a certain amount of time.
Yeah, but I guess the question is, can we earn that interest back? Like, can we invest at our arbitrage yield?
I doubt it, but I don't know. I don't know that answer, but and today the answer is probably no. Just from looking at
Years at what, 1%?
where the muni rates are and where the treasuries are. But I don't know that. I don't have that answer.
Well, I think maybe one thing, like, for the board to consider is if we're gonna invest for 20 years, we're gonna borrow for 20 years, and let's just use some hypothetical numbers at 2%. And we may only be able to reinvest those monies at 1.5%, that's 50 basis points of negative arbitrage. Then the question is, if you take 50 basis points, and I'm just gonna use a number here, Mark, and let's just say it's sitting around for an extra 6 months. If you take 50 basis points and then amortize that over 19 more years,
It's not a lot of money.
then you're raising your effective borrowing cost by 2 or 3 basis points.
Yeah.
So that means we're borrowing no longer at 2%, we're borrowing at like 202, 203.
It doesn't matter.
It's relatively small. I mean, we can run the numbers and see exactly what it is, but, a little bit of negative arbitrage
It's not
to
gonna-
capitalize on very low long-term rates,
It's not going to
because,
go.
it's a very small trade-off.
Okay, that's helpful.
One concern that
Although, of course, that 50 basis points hits in a year, right? I don't think you would you don't amortize that. I mean, you might as an accounting matter, but as a cash matter for the town, it would all hit in 1 year, right?
It would be over the life of the bond.
Well, yeah, but I think to Frank's point, while the money's not spent, we're not covering the debt service on the unused money. But I think economically, as we think about the overall cost, and we're gonna do a combination of right premium bonds and so forth like that.
I know, I agree with, yeah, no, I agree with you, but I'm just saying that it does show up in a particular year.
Okay. Jennifer, do you have a point?
We do not have a treasury department or a finance department that's staffed to do slugs and GICs and that sort of thing. So I think we may incur some costs to get assistance on investing those, rather than our usual plain vanilla, goes in a money market, goes in a CD. And I think for an issue of this size, we would want to engage someone to do our arbitrage tracking and calculation. So I think we may end up incurring some additional expenses if we go with something as large as 40 million. I think 20 million is more manageable with resources we have on hand.
And
Can
is that,
somebody reiterate what Jen said? It's hard to hear on the phone.
Oh, sorry. I was saying that at 40 million, we don't have a treasury department. Can you hear me now?
Yeah, that's much better, thanks.
Okay. We don't have a treasury department or a finance department that's staffed with resources that could do investments in slugs and GICs. So if we were to do 40 million, I would want to engage some outside resources for the investment as well as the arbitrage tracking. So I don't know what the cost of that would be, but I think we would incur some costs for the additional resources.
So your sense is that we would go with the lower bond amount?
Me personally, and having to manage it and administer it, I'm more comfortable with the lower amount. If you desire the higher amount, we'll make it work.
Okay.
Mark, has there been issuance in either negotiated, in the competitive, either via competitive or negotiated means in the last, call it 2 weeks, when we've started to see more of a dislocation in the credit markets?
There have been competitive sales that they didn't stop them from one reason or the other. Part of if they had notes coming due and they had to repay those notes and they needed to permanently finance them, a lot of that was kind of the scenarios. We've seen things getting done, and they've been getting done at pretty wide spreads right now. That's on both the competitive and negotiated. when folks had the opportunity to, especially last week, to postpone, they pretty much all did, just to kind of let things settle down. There was really, there was people were getting things done, but they were, a month ago, say your bonds are trading, 10 through the benchmark, they may have gone 50 over last week, if not more. So it's just, they were just doing whatever they could to get people to buy it. I'm hopeful, because I'm an optimist, that by the time we actually get to market in April, which we won't be ready to go to market till April anyway. I'm hoping the dust settles and enough things get done that they'll be able to properly market this. There have been sales this week. It's been better. Last week, on a competitive basis, we were seeing 1 or 2 bids per transaction on the deals we saw. This week, we're seeing anywhere from 3 to 7. So that kind of that kind of gave me a little sign of encouragement. But right now, I'm glad we're not in the market today, put it that way.
And just one follow-up on that.
It does take us a while to get prepared to do it. So, I think we stay on track, and then we can always postpone, because you don't necessarily need to price, or you need the money by May 1st or whatever,
How many bids did we have on our last competitive deal? And the follow-up to that is, would that number go up, down, or be roughly the same for a 20 million issuance versus a 4 million issuance, assuming the market is normalized?
So let's see, last year we had 9 bids for a $4 million deal. We probably would have seen something similar to this, for your $20 or $40 million deal.
Okay.
And in terms of when we need, go ahead, Mark.
I'm sorry.
Well, I guess my question was just in terms of, there's nothing that's going to force us to rush into a bad market. That we only need a few $1 million by the time we get in the third quarter, right?
Right.
So, and that can always be, as long as we have the bonding resolution passed, we can always use that from the general fund, right? And then
Yes.
reimburse the fund. So there's nothing that's going to push us to go from 10 through to 50 wide into that type of a
Right.
market, right?
Correct. Even if we went in the market today, I think you would get an effective rate, or TIC, of say 2.75. And then put it in perspective, last year's deal sold at a 2.67. So, and we were all pretty happy. 2 weeks ago, we obviously would have sold, closer to 2%, but unfortunately we weren't, it takes a while to get things teed up and ready to go. So nothing's forcing us to go to market except the need for cash, and if you don't need it when we get to market, then, and if it's a market like it was last week, we can always postpone it.
Remind me, if we do a competitive deal, do we have to accept the lowest bid? Or can we pull the deal if we're not happy with the lowest bid?
You would have to reject all the bids.
Yes, you could reject all bids, and
it's either the lowest TIC or you reject all bids.
okay.
Yeah. That's right. I think to Dan's point, if we go in on a given morning and the market falls apart, we're getting back bad bids, we can just pull the deal.
And you can always do that with a negotiated, but you can still do that with a competitive.
Yeah, you can always do it. It is, I would hope that we would pull the plug before we
Yeah.
saw all the results.
Well, yeah, it'd be
Hopefully
better.
we would know that it was going sideways in advance of that. But yeah, you always have that option.
And then as far as how much we issue, if we seek I mean, right now we have the authority, right, that the RTM gave us to issue up to 60-ish, right? Or
63.
63. So we don't need to decide, I mean, do we need to decide today on whether it's 20, 30, or 40?
We can move
Well, we
forward
need to-
with preparing the sale, but before we issue the OS, we need an absolute amount. And before we can really do the sale, we would need a resolution to sell passed by this board that has that actual amount.
Hard dollar.
So, and just by this board, right?
Right.
So if we were going to market the week of the April 13th, is that what it said?
Right, that's our target at the moment.
So just for illustrative, so how far in advance of that would the OS have to be final? Days?
Mark, do you have the
It
calendar?
would be
for-
about a week in advance.
A week in advance.
But I need to send around drafts and everything, so we would have to have some sort of idea of, when we're talking to the rating agent, we talk to Moody's, they need to run ratios, and if we're talking and the amount of the bond issue is blank, and we go to do ratios and it's blank, based on your current, it's gonna be hard to discuss that. You can always change it. Like if you could give us some guidance on how to move forward, it would just kind of help, because we're trying to do this relatively quick. We're looking to get a draft out next week. We're looking to talk to Moody's next week in order to try to price April 13th, or the week of April 13th.
So Mark and Jenna, as we think
And there
about,
wouldn't be,
go ahead, Taylor, or Frank.
oh, I was just gonna say, would the price be different on a 40 versus a 20? The interest rate?
Probably not. Probably not.
Okay.
So Mark and Jenna, when we think about size here, are the two real decisions just one, our view on rates? Like, do we like rates today or in a few weeks, versus do we want to sort of leg this out over 2 or 3 bond issues? And then the second thing is, in the context of making that decision about a view on rates, how do we feel about our ability, either internally or with the use of some extra outside resources, to hit our borrowing cost? Because if we're going to invest at if we're going to borrow at 2 and invest at 1.5, that is a cost that does increase our overall cost of funds. So it's sort of opinion on where we think overall rates are and whether or not, sort of how much friction we're going to lose in terms of not hitting our RBO.
Right. I mean, from my perspective, I don't like time to market. Right. It's you have projects. It's going to take X amount of time to build these projects. I think the market's undefeated in regards to when people try to time it. I think if you can afford it, this is good rates. I went back to 2017. We were at a 254 with an effective rate. I don't know if they're going to vary much. It really comes down to affordability versus, which I think you can. I don't want to speak for the town people, but from a budgetary perspective, when you look at all those factors, I don't think it blows things up, too much. But I would, it's really, it's a policy decision on what you think is you're comfortable with, and maybe it's not 20 or 40, maybe it's 30. I don't. We just ran it, kind of give you an idea of how it would look. Maybe there's a middle ground there. I don't know.
But what you're saying is you'd borrow the 41 million now, is that? what I'm hearing.
Well, no, I would borrow the 20. If you don't think you're gonna spend it all in that time frame in a year, you're in essence borrowing $20 million too soon.
In my own,
And if you're looking at spreading this out as long as you can with max deferrals and level principal and interest, then that would be the way to spread it out as long as you can.
yeah, my own judgment on this is I think the $21 million is the way to go. The reality is we've got the prospect of this work unfolding a little more slowly than we thought otherwise. And I get the fact that there's unlikely to be a significant financial penalty by holding this money over a longer period of time than what's forecasted here in this cash statement. That said, it's a management cost, right? We're going to have to oversee the money. You guys have got to make decisions about it, and it's a big nut. I guess what I would say further is that our ability to borrow in this marketplace is never going to be impaired. And so we're still always going to be able to borrow at the most favorable rate, whatever that is. And my sense is that we ought to try to match this debt with likely cash flow obligations of this project. And I would split this up and go $21 million now.
And to add to that, I think we have a pretty big window on the second 20 million. In other words, there wouldn't be any gun to our head to go into a bad market.
Yeah, I would agree with that.
What are our options if we go forward with 21 and we go forward with the April 13th date and we have a dislocated market that week and we choose, it's just a bad time to go? How much more time do we have before we have to do something, just for cash purposes? We're recognizing, I guess, we have our general fund, but we may be needing that for other purposes.
Fair.
I would say we have a few months. Looking at the cash flow and cash that we have on hand with fund balance, we can certainly front the cash from the general fund for a few months.
Okay.
Yeah. Any further sentiments from you?
Yeah, I mean, I think what we should, a couple things I'd like to see is I think we should just kind of slide these percentages forward just to look at the very earliest bond issuance date, which would be sort of early May. So does that change any of our kind of 13, 40, 79% targets here?
Yeah, so said another way, this chart here where you've got the projected expenditures by month.
Yep.
It might actually be nice to have a further column that says this is the cumulative spend to date, and then two more columns that would say here's the percentage of that bond issue that's expended by that date. So we actually see it by month instead of by, what is it, quarter? Or what are they?
Yeah, these are the 6-month spend down requirements for the arbitrage.
No, I get that, but you got the cumulative list here that's by 6 months, and I'm just saying if you did it by
prior
month
page.
here, on the previous page, if you did this by month, we could actually see the percentages just a little more precisely.
Well, so what you're looking at, to date, we've spent 545. Using the cash flow plus what we've spent to date, by 9/30/2020, we will have spent 4.5 million. Then
Yep.
by 3/30, we will have spent 15.6 million.
Yep.
Yeah, I guess, I think John was just saying, because
I'm
it's
just
kind of
saying,
lumpy here.
that's perfect here,
Yeah.
but you've just got it broken down into 6-month periods. If you look at the previous page, it's the same data. You could do the percentage,
Yep.
in a spreadsheet, this will take 30 seconds, but you could actually calculate those percentages. We could just see it by month as opposed to every 6 months.
And let's update it to May, right, just to see.
Yeah, right.
And for the current rate environment, which is different, and understand it'll be different a month from now, but what we just heard is it's 50 basis points wide of where we thought it was.
Well, no, I think,
Well,
I
that's
think
not
what
relevant to
Mark
this
said
schedule,
was.
but
I
yeah,
mean, if
it's fine.
Okay.
And then I think the other thing is, maybe as we think about the size, just because like whether it's 21, 31, or 41, should it be targeted to be some percent of what we think will be spent? Should we target 50%, 60%, 70% of what we expect to?
That's a good
To
question.
like, I'm just looking at this, after we update all these numbers and so forth, should the dollar amount just be something that is, if we have to be at 75% in 18 months, should it be a dollar amount that says we'll get to 60% in 18 months? Like, should there,
Yeah,
like,
so
what is our
instead-
actual rationale here?
Yeah, so instead of spending, well, yeah, so if we're looking at March 2021, we're looking at nearly 80% spent on that date. So if we wanted to say, we don't want to have to borrow again for another year from this March, call it mid-April, and we want to make sure that we don't go over that, maybe we borrow enough to get that, to set that number at 75% or 70%, that's what you're saying?
Or maybe, John, to your point is, which I thought you were saying, is let's borrow 100% of what we expect to spend in 12 months or 13 months or 11 months. Like, how long do we want to kind of cover ourselves so we don't need to dip into the general fund?
Well, hopefully we don't need to do that, as we'd come up on this day, we would just get ready to do another bonding, right? Or when you come up to where these funds are expended, then
Yeah.
that's just time for the next tranche of borrowing, right?
Well, yeah, that's what I mean. So depending
Well,
on how.
borrowing a little bit from the, okay. Right? I mean, it helps us deal with this whole investment income question.
I guess if for a base case is to spread out the deals by a year, let's just
Right.
throw that out there, because then the issues around managing longer term investments and the risk of not hitting arbitrage yield is lower and less taxing on sort of treasurer and finance department, everything. So if we want to plan another deal in a year, maybe we should bond for an amount that'll cover all the proceeds that we would expend in that year or in 13 months, just, I think, come up with a strategy.
Well, according to this, about a year from now, we will have spent, call it 16.7 million,
Right.
and we will have spent 80% of a $21 million bond issue. So if that's the kind of year target point, what bonding amount would you recommend that we bond today, since when we get to that point, that feels right?
Well, if the arbitrage yield is, or that target at 75, maybe you have a little bit of a cushion and you make sure you're going to spend at least, 85% rather than 79
Okay,
of the money by the date. And then I think if we should look at, like, when we get out 12 months, and this is all going to roll forward by a couple months, right? Just because we're going to update this to May. So if the question is, if we want to bond 12 months worth of expenditures, and that's our base case, how we're going to spend it and size it, then what happens in month 13, 14? If there are big, like $3 million, $4 million needs there, do we want to maybe bond 13 months? I think it's,
I mean, I could go either way, what do you recommend?
yeah. I mean, I'd like to run the numbers, but it feels like something maybe kind of between 21 and 30.
Recognizing that if we do another deal a year from, we're still going to have to do it. Either that's going to have to top us off all the way, or we're going to have to do a third deal,
Yeah,
right? Sometime thereafter.
I would expect we won't know our final amount for a while because we are expecting state grants. And so even though we've been authorized for 63 million, we're going to borrow 63 million less the state grants. So at some point, probably, because the state does take a long time to finalize the grant amount, our very last issue will probably be small, but it will probably be a bond anticipation note that will roll until we get our final amount from the state. So even if we do one issue now, one issue next year, there will be another issue.
Jen, what are we expecting from the state at this point?
I think it was 4 or 5 million
yeah.
was a very rough estimate.
Okay.
3 weeks ago, we don't know today.
Yep.
Should we just borrow the $21 million and call it a day? Should we do the detailed analysis like maybe you're proposing? Should we split the difference and make it an even 25? I'm not quite sure how precise we want to get about this. What's your sense?
Well, my sense was if the target was 75, we should scale back what we borrow so that we're, at 85 or 90, some cushion so that it doesn't fall back and become a lot of work in terms of tracking investments.
I agree.
So that would be less than 21.
Well, because what,
Whatever the amount says in 12 months,
16.7.
but this is all going to be rolled forward a few months.
Right.
So
Okay, I see what you're saying.
whatever the amount is in 12 or 15 months, however far we want to cover expenses for. Like, when do we want to not have to be back in the market for?
well, I mean,
Again,
part of the reason I'm a little reluctant to get precise about that is that's assuming that this cash schedule is going to be precise, and having sat in all these building committee meetings and one for Public Works Garage, it just doesn't work that way. So, I mean, I would almost be inclined to pick a number and then allow the calendar to do its thing, right? So we may end up spending this money a lot faster, just for grins, let's assume that, in which case we're back at this in 10 months. Or it's a lot slower and we're back at this in 14 months. I think we're hopefully be within the requirements of spending the bond money. I think we're at a lot less risk if we go with $21 million than we go with $41 million. But my sense is that you kind of just have to pick them out. It's going to be too hard to be precise about this, to adjust the borrowing, especially when it's a false, this cash schedule is a false precision. I think we're going to get to $63 million eventually. That I'm very confident of. I just don't know when. So again, my recommendation, they've already run the numbers for $21 million. That feels like a round amount that gets us in the zip code of a year from now needing to do this again. It's consistent with what Jennifer says that they can manage. Mark thinks that's the right recommendation or right number. I mean, we can adjust it 2 or 3 million here or there, but ultimately I don't think it matters. My recommendation would be to go with 21 and call it a day for right now. And I don't think I'm oversimplifying things, but tell me if I am.
I think 21 is probably the right number for the one reason you just talked about, which is this is not going to get done earlier, it's going to get done later. Right? If you look at just what's out there right now, some people are talking about this lasting till August, some people said June. It's a big unknown at this point. You've sat on 2 building committee meetings, you know how they go. I'd rather go smaller than larger, just my own 2 cents.
James, you're the expert. What do you think?
yeah, I'm fine supporting 21.
You're right. I mean, would you do something different? Tell us, because you know this better than anybody on this board.
I'd like to see the numbers, and what I would say is it also depends on where the market is. If the market sort of snaps back and people start looking for a flight to safety and our borrowing cost comes down by 25 or so, well, that would make me feel like we're bouncing off sort of our lowest ever ticks,
Yep.
and I might do a little bit more.
Okay.
But
All right, so that's a great point. So in that vein, what should we do at this meeting? Right, in terms
well,
of-
ultimately, are we going to approve it at next week's meeting?
We are not expecting to have a meeting next week. So if possible, I think if we want to be able to know that this is approved, we can move forward regardless of what happens out in the crazy world. We should approve something today. If we want to take the chance that we will be able to meet next week, this can be delayed.
And we have to approve an exact amount of bonds, or should I say bonds generating proceeds of an exact amount? Because we're going to do premium and discount bonds here, right? Or premium bonds.
We need to specify the exact amounts for each project that we are issuing in the resolution itself.
Of proceeds or of par amount of bonds?
Par. Like if,
Par amount of the bonds. You could adjust, this is Mark, by the way, I'm sorry. If you wanted to do, because premium associated with the bond issue are technically bond proceeds. So if you wanted to, you could adjust the par. I think we're safe to assume you're going to receive premium on this. So if you're concerned, concern might not be the right word, but if we're talking 20 million for the school, you're probably going to get, depending on the winning bidder, if it's a competitive sale, we're going to get a good amount of premium. So that's proceeds that can be used for the project. So you might end up with 24, 25 million.
Yeah.
So does everyone understand what he's saying? Like, all the discussion we've been having here around $20 million of bonds for the school is like, we get $20 million of cash, less a little bit of cost of issuance here. But inevitably, just because of the way the environment is, we're gonna be issuing higher coupon bonds, like, 5% bonds to yield 2%. So it means is if we approve $20 million worth of bonds,
face
we're
value
actually
is
going
gonna
to
be a
get
lot higher.
24, 25 million of proceeds. I think all of our discussion about spend down is really related to proceeds. So if we're saying we want 21 million of proceeds, and Mark tells us that, I think that you're going to issue on average at 107, then we should approve.
21 times 107.
Or divided by.
Yeah, divided by.
Well, so that's a fair point. I mean,
Okay.
right, because.
That's 7%, right?
Right.
But you can resize the deal so if you want 20 million of proceeds, you can say, if they give, I'm just using round numbers here for my sake, if they give us 5 million premium, our total proceeds can be 20 million, and we resize it to be that. So you're only gonna pay debt back on 15 of the 20 because the other 5 is cash.
That's fine, but what is
You can resize that.
what does our
That's all
resolution?
part of the notice of sale. You can copy that.
Yeah, but so then, if we can resize the par to dictate the proceeds we're gonna get, what par amount needs to go into the resolution?
Or tonight, is it up to $21 million worth of notes?
I have a Jennifer saying we have to specify a par amount.
Which is difficult to do, not knowing what the premium's going to be.
Well, of course
Well-
not, of course I'm saying all this.
Do you know if you can, if
So-
it can be worded to be like a not to, like sort of like the refunding resolution, it's a not to exceed number?
Right, I think the other projects, the 1 million of other projects, those are definite amounts. And then in this resolution where the resolution that I put in front of all of you, the first blank is our amount, general obligation bonds for Oxbridge. In there, I think we could insert an up to 20,985,000. And then for the second blank, sold as up to, or not to exceed 21,060,000.
And of course, we're saying all this, and I just said before that these small amounts sort of, one way or the other, in the scheme of things, don't matter, and that we're attaching them or trying to link them up against a cash flow schedule that's in total is correct, but it's fake news in terms of whether it's right on a monthly basis. So my vote would be, let's just pick a par amount. The actual proceeds will be different in a way that we can't set or understand right now, just because we don't know how it's going to play out. And maybe we just say, fine, it's likely, to your point, going to be higher by a fair amount than whatever the par is. Why don't we just pick 20 million bucks? That covers everything. That'll give us more proceeds than is stated. But fact is, based on the earlier conversation, we can manage that and be done. Jennifer,
Yes.
is that all right?
Yes.
Yeah.
Mark?
Yeah.
Jim? Yeah. All right. So why don't we just fix the par amount now, then that way you don't have to do an up to amount and you've got something certain for that resolution. Does that work?
That works.
Okay.
So he's wanting 21 million of par, right?
Yeah, we could just do 21 million a par, which is what all this is.
21 or 20?
Well, I would
so-
just do 21 because that's what's in all the.
Right, so we would do to make the numbers work, because we issue in $5,000 increments, it'd be $20,985 for Oxbridge. Total issue would be 21,060,000 total, 20,985,000 for $20,985 for Oxbridge.
Okay, and I'm sorry, the total issuance would be how much?
21,060,000.
Okay.
And then 2985?
For
Yep,
Ox- for
$20,985,000.
$985,000, that's just for Oxbridge, okay.
So it's only 75,000.
So what you need is a motion to approve the bond resolution for $21,060,000.
Right, before we do that, if we could designate a representative for the sale, because we have a spot for that on both of our resolutions. So we are required to have a Board of Finance
is
representative
that?
for the sales.
What day is that?
If we issue on April 13th, it'll be on April 13th. If not, it'll be on a different date. You do have the option. Mark, we've had Board of Finance members call in before, correct?
Correct.
Well, I actually expect to be working from home. I will volunteer to do it myself.
We all might be, right?
Yeah.
And just to be clear, we're going to make sure that market conditions are good at the time, right?
Yes.
So, because to me, the bond market's not working correctly right now. There's no way of,
kind of one of my concerns too.
Yeah,
a 30-year doesn't go up 30% in one day like it did today. So we needed to kind of stabilize. And then whose call is that?
yeah, I mean,
Whether
I
it's
think
285 or 20.
to Mark's point, recently an issuer who typically trades 10 through the curve, priced 50 wide. I don't think we're at a point where we need to pay 60 basis point new issue premium effectively, or a
Agreed.
liquidity premium. So I think we need to be very smart about when we actually go to market, and
Okay.
not just sort of, we don't want to just go on April 13th because,
Right,
And
and
that's-
what
and
you're
that's all- and that's all
approving
I'm
in this
saying.
resolution, the last sentence of the first paragraph says that the bonds shall be sold, mature, and bear interest on such dates as determined by the finance director, designee of the Board of Finance, and the town's professional advisor, so Mark.
Okay.
So,
It'd be-
so that says we have flexibility, so just how much flexibility do we have, right? So it's a kind of a question, is this all within a 2-day period, a
No.
2-week period? What?
No, it's kind of open-ended, the way that bond counsel reworded it. Because normally, we would have put in here, we plan to sell on or around April 13th, and we expect them to mature May 1st, interest payments, such and such.
So we have a lot of flexibility to do this.
We have a lot of flexibility on timing the way that this is written.
Okay, are there other factors that would constrain timing, right? So from an Oxridge standpoint, we have enough money in contingency and fund balance to float those guys for a while. The refunding, I'm assuming, is really contingent on market conditions, so we just need to play this by ear for everything sometime within some discrete period and pull the trigger when we collectively think we're ready.
Right, if we delay beyond June 30th, so right now, the way that this would work is, if we assume we're going to issue before June 30th, when we have our budget discussions, I will update the debt service numbers based on this size issue, anticipated rate, deferred principal. And if we issue before June 30th, we will have 2 interest payments in the next budget. If for some reason we delay beyond June 30th, we will have 1 interest payment. So that's another impact from timing.
Okay. So any other questions on any of this?
is there any period in terms of, just given June 30th is the end of our fiscal year, as we think about sort of disclosure documents, like when do we go stale in terms of not being able to issue? Mark,
So so if you're saying if we go to market, we distribute a document, just say April 1st. When is that document no longer valid? Is that kind of the question?
yeah, is there any period that we're locked out because of the timing of our fiscal year end and when we deliver financials?
No. The market understands that, in Connecticut, typically, especially for you folks, it's done before December 31st, and we've gone to market, even much less credits than you, with not having audited financials, 9 months after the fiscal year. So it wouldn't go stale from that perspective. It would be more, we would have to update it because, say we did do this April 13th, you don't have a budget, but if we did it June 13th, you probably would, so we'd have to, we have to update the information to put in the most recent adopted budget or proposed budget, things like that.
Okay.
So Jennifer,
Taylor, can I just ask a question?
Sure. Please, go ahead, Taylor.
Can you guys hear me?
Yes, go ahead.
I just want to make sure I understand. So we're leaving ourselves, I understand we have flexibility in the timing, it sounds like, but to Jim's prior point, are we boxing ourselves out of having any flexibility in the amount that we're going to issue? Like, if rates really do snap back, are we saying or cutting ourselves up to the possibility of borrowing more money in April?
By passing this resolution and setting the amount like we're discussing, the answer is yes. Could we issue a second bond for that amount and just go through this whole process again if it was extremely favorable, and convene a Board of Finance meeting to do what we're doing now, but just have a second bond issue to double the amount that we're actually going to market with? I think the answer is yes.
Yes.
So I don't think we're at risk right now of setting this amount in a way that overly constrains us. We can't do anything, we can't change this resolution, but we certainly could entertain another resolution and borrow as much money as we want if the marketplace becomes suddenly favorable. It's a good question.
We couldn't amend this resolution? I mean, I guess one thing is if things
Yeah.
4 weeks from now changed materially,
As they have in the last 4 weeks.
yeah, could we either increase, decrease, or?
Well,
Could we amend the resolution?
you can amend the resolution, but it is a question of how far along we are in the process.
Because if you've already been to the rating agencies, then you got to go back to the rating agencies.
Right, if we would change the amounts.
But that wouldn't be the end of the world. That happens. That happens.
Yeah,
If
the rating
it's really
agencies-
materially different.
Yeah. But the rating agencies saw that we approved a bond resolution for up to $63
Three.
million, and so they know it's coming, right?
They know we're gonna issue it at some point. But like Mark said, when we do our ratings, they're gonna look at how much are we issuing and what does that feed into for their data points and what does it say about our ability?
But we're not detailed, we're not locking ourselves in. I mean, it's not ideal if we were to change the amount up, but there's a process that would enable us to do that if we find ourselves in that kind of an environment.
Right, an extraordinary
Okay.
environment where we say, absolutely, we need to issue more, we will find a way to do that.
Yeah.
Yep, great question.
Is there any way to expedite, like, an additional issue? I mean, does it always take a month to do this, or can we do like an upsize or some kind of a ride-on or something like that where it can be done in a faster manner if we wanted to upsize it?
This is Mark. So if we came up to April 3rd, the week before, and we only have 20 million for Oxford School, and the market reverted back to how it was in February, early February, and you wanted to increase it by whatever amount, I'm sure we could adjust it. That wouldn't take the month. The month is collecting all the data to update the official statement from last year to this year. If it's just changing the par amount, then we can turn that over relatively quickly. That's whatever tables that are in the official statement. So that won't take a month. That would take a day or so. So we can certainly adapt to that. And if we're going to be monitoring this, I mean, unfortunately or fortunately, I'm looking at the ticker every minute. I'm looking at this. If you ask me today, I don't think we're going to be there, but hopefully some nice stimulus package gets adopted and the market likes it, and we keep it reverses, and I'm back on the phone with you next week or 2 weeks saying, hey, we are better. Things are easing up. People are more comfortable with going in the market. You might want to optimize your borrowing amount and maybe look at adding, some amount. We can certainly do that. We're going to be monitoring this very closely. I'll give an update to Jennifer next week on, where we were in February, where we're today versus next week, and how the market is feeling. So I don't know the mechanism from a Marie Phelan or bond counsel perspective. I don't know if it's just a simple amendment to that resolution or if it's a whole nother one. But it seems like you're meeting almost on a weekly basis, because you're getting into the budget and stuff. I don't think we're necessarily handcuffing ourselves. We just said 20 million, now we walk away and we're done.
Okay. That's great. Other questions? Anybody? Other questions? Jennifer, what resolutions do we need to vote on?
So the first resolution is the one that you have in front of you that had a couple of blanks, and what we're putting in there starts to be resolved at 598,654 general obligation bonds. In the first blank is the amount for Ox Ridge of $20,985. And then the second blank is our total to be issued of $21,060,000. And then the final blank is that we are designating John Zagrodzky or his designee as our Board of Finance representative.
Okay, so we'll get to the, refunding here in a minute. Motion to approve the resolution with the blanks filled in as Jennifer has specified. Dan, second. Jim? Okay, all in favor? Everybody on the phone?
Participants by phone.
They can't vote,
They can't.
but I want to hear their vote anyway. You guys okay with this?
Yeah.
Okay.
Yeah.
So recorded vote of
Yeah.
5 to 0 to 2, I guess. Okay. All right, now we have the refunding bonds, correct?
Correct.
Okay, Jennifer?
So we do have the opportunity to refund about just under $14 million of bonds. What you have in front of you is dated February 10th. That was what Mark had available at the end of last week. That was closely mirroring where rates were on that particular day. So this is one, the resolution would allow us to refund up to $15 million, par value not to exceed $15 million. And again, this leaves the date open-ended and the decision whether or not to really move forward with the sale in the hands of the finance director, the designee of the Board of Finance, which would also be John because we do all these together, and the town's professional advisors. So right now, the way that, as of February 10th, we had some, it was favorable. We had some net present value savings, net present value savings of about $581,000. As a percent of the refunded bonds, it's 3.87%. And our cost of issuance is estimated at $75,000, and the underwriter's discount at about $47,000. But this would certainly depend on market conditions, whether or not we went forward with the refunding.
Jim, I know you've taken a look at this and had some good questions earlier by email. What do you think?
So I guess, Mark, it seems like the rates that we were assuming in here when we did this analysis were all kind of in the 0.8 to 0.9% yields.
Yeah, so these, once again, so these were, if we would ask my desk, their guess is as good as mine in regards to what the yields, would be. This was last week, we had to prepare this. So I looked at where we were on that day, and since then, actually, they're 50 basis points worse. So it's more of the the rates are going to be what they are on that day. Once again, we don't have to move forward with it. My recommendation is just to have a resolution approved so that we can be nimble and move. If the market continues to deteriorate and we're not at the threshold you want to be at in regards to savings, we don't do it. And we hold on to it until hopefully the market returns. It's just, perfect world, we would have been ready to do this, January, February, but who would have known, all the things that have happened since.
Well, Mark, as I understand it, like page 3 and page 4 of the BBC printout or whatever, this shows the two different bond issues, the 2012 and I think the 2015 issues. Those are the ones that we'd be refinancing, right?
Correct.
And so maybe just to point out for the board, the bonds that we'd be taking out, we'd be refinancing, all have 5% coupons on them, except for at the top of page 4, you can see there's a small 4% bond.
Yep.
So in terms of absolute dollars of savings, you know, even as crazy as the market is today, Mark, right, we'd be able to issue below 5%, right?
Right, so that's the rate of return. So you're looking at the full savings report. So if, in this scenario, your total budgetary savings, cash flow savings would be, and that's shown on page 6, would have been $595,000 if we priced it on that debt. So you would have had debt service savings of roughly, they did this in level, in essence, level savings of roughly $75,000 a year. So it's not, you are issuing a 5% coupon, but if you notice, the bonds that we're refunding is roughly $15 million, and we're only replacing that with $13 million. So it goes back to that bond proceeds question you had. So on refunding, your target is what you need to pay the escrow. What do you need to fund the escrow in order to pay the bondholders on that call date? So it starts off with, you need $15 million.
Yeah, but I guess, Mark,
I can show you where that.
yeah, Mark, what I was saying is like, sorry, the bonds that we're refinancing, right, are on page 15. Page 3 and 4 kind of show what bonds we're using to refinance each. So
Your savings is going to be, in essence, on principal, not on interest. But you look at it in totality, your savings are on debt service. So you see where we're refunding $15,045,000 of bonds, and you're replacing that with $13.3 million.
understood. But the coupons we're taking out are between 2% and 3%, right?
Correct.
Yeah. So
You're replacing them with 5s.
yes, but sold at here a yield below 1, and now a yield obviously something above that. But in terms of whether it makes sense to refinance these, we think about the yield that we can sell new debt at
Not the coupon,
versus
right.
the existing coupons.
Yeah.
So I guess what I'm saying is like if we're selling new debt at 2.25%, would you be recommending that we take out a 2% coupon? And I think the answer would probably be no, right?
No.
So
Right, yeah, it would be. But this, so we're looking at, so this is, the refunding is a very short transaction, right? It's only going out 7 years. So where they are at, this was on February 10th, we're at yields of, 80 to 90. Right now, we're at, 135 to 150. So we're about 50 basis points higher than we were on February 10th. What does that do to this transaction? It reduces the savings by about $225,000. And to me, and we have to decide on what we have to come up with thresholds and what are the minimum amount of savings we want to move forward. And we can certainly discuss that. So if it was today, we would probably be a present value savings of 2.7% versus. I'm sorry, I got a lot of things open up on my screens here. Was it
3.87.
3.8. 3.8. So we've lost a percentage point over the last month.
Mark, what was that total? Sorry, could you repeat what the total savings was? And do you have the NPV of the savings at the current rate environment?
Yeah, so I didn't rerun all the numbers, but I went through and I have a way of kind of calculating it within reason, and it's roughly we've lost since February 10th about 50 basis points on average. So when you do that 50 basis points, it reduces the savings by about 250,000, 225,000. And then, so it reduces the savings, and when you do the math, it brings it to roughly 2.7%.
So the 531,000 of present value savings on page 7 is now down to about 300,000.
And is the con,
It's 370 something, 370.
and is the cost of issuance and the
Because it's
underwriters,
against the 595.
is the cost of issuance and the underwriter's discount, is that additive? Or is the underwriter's discounts?
This is a net
Yeah,
savings.
yeah, the net savings
So
takes into account all those costs.
And if we were to do this all
No,
together with
but-
the new money,
It does along with
this wouldn't, you'd have some economies of scale with that as well. So it wouldn't carry the, if this was done on a standalone basis, the fees would be as presented here. If we did it together,
So-
and the cost of issuance, 2 separate issues are 75,000 each. That's for everybody.
And all your,
Council, us, rating agency, printing, all those things together, maybe it's, I don't know, 100,000.
but
There is an economy of scale.
we're assuming we're doing this refunding.
And underwriters-
We're assuming we're doing this refunding concurrent with the other bond issue.
Yeah, I mean, I kind of would. And
Well, yeah.
as much as I would appreciate 2 separate transactions, I think if we're going to market and the transaction is still viable, then we do them together.
Okay, Dan,
If it's not, then we scrap it and put it on the shelf and wait for the market to turn around. These are currently refunded bonds, so every payment that goes by is an asset that we've lost an opportunity to refund. So as long as we do this before August, we're good.
Okay.
The next payment on these bonds, on both sets of bonds, is August 1st.
okay. Dan, did you have another question?
Yeah, it's just the math. Does the cost of issuance include the underwriter's discount? Or are those
No.
two independent numbers? So is it another way of thinking about it? And I know the cost savings include these numbers, but just as it was written up in February, it would cost the town $122,000 roughly, 75 plus 47, to achieve, to basically, to pursue this refunding. And therefore, is that a fair way of looking at it? The expense to the town of pursuing this
That's like
bond
that's like
would
a-
be,
Go ahead, Mark.
I'm sorry. I apologize, I'm not there. Yeah, so that's a 5-to-1 ratio. That's good, right? So if my back of the envelope calculation is correct and the savings comes down to 370,000, we're still at a 3-to-1 ratio, which is still a good ratio.
okay, that's exactly what I'm looking at.
You're
That's
still-
exactly what I'm looking at. At some point, the ratio doesn't work any longer, right? It's costing us too much.
Correct.
And we're saving too little. But what you're saying is that the ratio is still healthy.
Yes, especially on current refunding bonds, because you have, this is a waning asset, right? So the threshold on, advanced refundings and things like that, we would say, you could wait for the call. You don't need to rush into it. This is, if we get to, less than 2-to-1, so your net savings is 2 times greater than your fees. That's we're starting to say, why are we doing this? You're basically, you're paying us to swap your bonds. You know what I mean? It's not.
Yes,
It's not
but
really.
isn't there another factor, which is what are we earning on the 13 million? We're gonna use $13 million, right, to do this? So we're earning something on that.
No,
We would forego that.
We're issuing new bonds to
Yeah,
replace the old bonds.
Yeah,
This
we're
isn't,
not-
okay, this
we're-
isn't
we
like the
don't-
deal.
these-
Okay. no.
We're not, there's not gonna be any
Okay, so
proceeds
just
we're
a-
holding.
so there's no, okay.
This is
Assuming
just
we
a,
close the deal, like let's just say in May, the 15
Never
million
mind.
that we raise will just
Never
be
mind.
invested for like 60 days
Yep.
until
Right.
Yeah.
Okay.
It'll be 30 days. It'll be inside of 30 days.
Okay,
So the
so,
call date is August 1st.
okay, so what we need is to vote on this resolution for the 15 million stated with me as designee, and we'd have the same sort of flexibility that would be tied to the other bond issue, and we'd do this concurrently, correct? Does anyone have any further questions on this?
I do.
Please.
So the current listing of the bonds we're gonna basically refund is the ones on page 2, right? 4, 3, 4, 4. Like, which ones are we looking at here? The ones on page 2, right? 13,585,000 is the principal?
No, the bonds that we would actually call that are outstanding today
Yep.
are listed on, like, the output page 15.
Okay, so just kind of curious, why are we showing 2 to page 2, 3, 4, and 5? What does that represent? Just a different bond we have out there right now currently? Why show it? Why is it in this presentation?
Maybe Mark, I'm happy to explain it. When you look at refinancing, like we're issuing some bonds to refinance one issue, some bonds to refinance another issue. Rob?
These are the new bonds to be
Correct.
issued.
There's 2 series of bonds that are currently callable on August 1st. We're going to take, again, in essence, 2 bond issues and make them into one.
That's the 2020 issue.
So the bondholders for those old bonds are going to get paid off on August 1st, and we're going to have new bondholders in May or whenever the transaction closes.
So the ones on 15 are the ones we're currently doing. Are they, when it says non-callable at the top, are they not non-callable then? Because clearly we're calling them early.
Page,
I missed that question.
So if you look at the page, at the top of page 15 that Rob's pointing out, it says in the title
Yeah.
that these are Town of Darien, Connecticut bonds, general obligation refunding bonds, rated AAA, non-callable.
Oh, the new bonds, because it's only 7 years, are going to be issued as non-callable.
All right, so this is
This
about
is
the
just a
bonds that are
header.
going to be
It's
issued,
a
not the
header.
description of the
It's just
bonds
a-
that we're trying to
It's just the
It's
header.
just a header.
If we were to do
It
this
doesn't
together,
describe what's in the
we
table.
were going to,
It's
with
just,
the new money that's 20 years, they will have a call on it.
Okay,
That's where the
these are the bonds that are being called, these 12s
okay.
and these 15s.
negotiation or discussion with the underwriter would be to, let's, is it 5, is it 7, is it 10? What is the sweet spot in the market today? But certainly not doing them, doing them non-callable is non-starter for a 20-year AAA Darien piece of paper. It's just, we're not doing that.
Okay. Any other questions? Jim?
so 2 questions were, in terms of taking out of the bond that matures in August and replacing it with a new bond that matures in August, do you typically see issuers refinance bonds that are coming due in such a short window?
Are you referring to that $85,000 payment?
Yeah.
Yeah. We have not engaged Piper Sandler, so that was their run of the numbers. That was unsolicited, provided to us, and then, I spoke to Jennifer, and that's where it started. We would talk to him about, I believe putting that short payment in there helps with some of the cash flow savings. If you remove it, then, because we're still, once again, the target is what do we need to fund the escrow, and how do we fund it? So if we pull that $85,000 out of that one short payment, what does that do with all the cash flow savings? So we would, we're not locked into any of these. We can have that discussion. I believe one of the questions was, can we add cash to the transaction? You can certainly do that as well. So if the town wanted to provide proceeds, if you wanted to have town contribution, you can do that. And now all that does is go to help fund the escrow without issuing bonds. not to further complicate things.
So I guess that was one question, again, rather than paying for the cost of issue an extra 85,000, we could just defease it.
Yeah, and that was in your note. I'm fine with just prepay that out with cash.
Well, you're not defeasing that. That's not issued yet. So we would tell them, well, we don't want to make a payment in August of 2020. And they'll say, okay, they'll pull that out of there, and then they'll add that 85,000 into the other maturities. And then what does that do to the savings? Because once again, we need they're solving for what is going to fund the escrow.
Yeah, no, so I guess what I was saying is we don't necessarily need to issue debt to refinance that. We could just pay cash to take it out, like just.
The escrow, right?
Yeah, or just pay it in the next fiscal
You would
year.
just, at closing, you would say, if this is the 85,000, we're just using that number, arbitrary number, you could say, at closing, the town will make a contribution of X. But in order to, and I don't know any of these things, for you to do that, you would probably have to have some sort of authorization to spend the money, right? I don't fully.
Right, we would have some Board of Finance action required like we did for the early redemption that we did in November.
And we need an RTM resolution for that.
RTM, no, because we have the refunding resolution that's been amended
right.
that allowed you to do it,
Okay,
but
right,
you would
right,
still
right,
have
right.
some administrative items that you as a board would need to do.
So I guess, so my only other question, I guess, to your point is, like, is there some threshold of savings that we want to achieve in order to do it? And I think there should be some absolute dollar amount that I think we should probably have, and I think we should also, dictate, because some percentage savings. I don't know that, when we look at some of these individual bonds, if a bond currently has a 2% coupon on it and due in 2 years, I don't know if we want to issue new debt just to put a 1.9% coupon on it. So should there be some minimum basis point savings? Mark, like, if you run a screen on these, is there typically some basis point improvement that you look at to sort of make it all worthwhile? Would you say 25 basis points, 50 basis points, depending on the actual tenor of the bond?
Yeah, I think, if you want to say, you can run a model that says, each individual maturity needs to have, 2% savings or whatever the number is. When you start stripping it down, though, right, as you pull bonds out, sometimes you need a little bit of math. This is, it's big enough, so if we lose one of these small $315,000 maturities, that's fine. We're, there might only be 1% savings on that one maturity. That's probably okay to remove. A lot of times, folks just want to, refund all the callable maturities, but we can certainly cherry pick them. If you want to use a number of 2%, historically, we've talked to the finance director and the designee and would say, where are we? This is where we are. Do we want to keep moving with this? Do we not? There's times historically, we almost walked away from a deal. We were about the price of refunding and we didn't meet our threshold and we were going to walk away and actually the underwriter lowered their discount to make sure we got over the threshold.
Well,
We can certainly do that.
Jim, what are you trying to avoid? Why are you, what are you trying to avoid? Kind of reputation in the marketplace?
Well, no, I think the point is, given that we only have one shot effectively at a tax exempt refinancing of these bonds, they've done away with like the advanced refunding concept. If we take a bond that matures in 5 years and we refinance it, we only save 10 basis points or 15 basis points. then we're then locked into a new non-callable maturity for the next 5 years.
What you're saying is you want to set a minimum threshold so that if you don't make that threshold, you just wait.
Correct. I think we want to make sure we're sort of getting the best value for exercising our call option.
So if to elaborate on that point, if you go to
Right,
page,
you're trying to,
if you go to page 8, page 7 and page 8, it looks like at 85 basis point issuance, the lion's share of the present value savings is in the 12 bond, and that's at 85 basis points. At 135 basis points, I would suggest the math on the 15 bond might be don't do it. If it's only $45,000 at 85 basis points, net present value pickup, at 135 basis points, that's going to approach zero or even negative. I would guess. I mean, you have to run the math.
Yeah.
Is that fair, Mark?
That's probably fair.
Yeah. So to Jim's point,
And we would do it.
we wouldn't do the 15 bond. We just do the 12 bond because that's where we're getting our savings at 135 issuance versus 85, which is what it was run before.
And on page 8, to Dan's point, we're saving 200 in year one and then losing 30,000 in each of the next 5 years.
And that was at 85.
That was at 85. So
This is gonna go away, right, Mark?
And we would have, say the market was the same, we would talk to them and say, I don't want any dis savings in any year. And they would tweak the numbers. Once again, we haven't engaged them, I haven't had them running, multiple gyrations, just because we haven't, agreed to use them. So, we would tell them how to structure it. Based on today's market, maybe these don't work and then we take them out. Once again, the resolution is a not to exceed number. And we're not gonna recommend, I'm not gonna recommend a bad deal for you to get a deal done. I've been doing this 20 years. Connecticut's a small state. Word will get around if I'm squeezing deals in. And I'm here to make sure that you guys, get the best deal for your money.
Yeah, and Mark, I don't think anybody's suggesting anything like that. It's just the market's moving quickly, and you ran these numbers when you ran the numbers, right? So we appreciate all that work.
Yeah.
It just looks like the numbers probably wouldn't work in today's rate environment on that issue. That's just an observation.
So Jim,
It's a fair assessment, yeah.
So Jim, if you were to maybe articulate a floor, whether it's the basis point savings or total dollar NPV savings, or the fact that you don't want any dis savings in any year in the schedule of sort of present value here, is there something you could articulate?
I guess I would try to think about it as like on an individual bond, you would want at least, somewhere between 0.5% and 0.75% savings. And then as a whole,
Minimum.
yeah, as a whole, we would want, I feel like a minimum of sort of 1.5%. And I think I want to make sure that, when you look at the two savings analyses, kind of one deal produces a whole bunch of, cash flow savings in the first period, which is obviously, we're talking about low PV rates here, but that's offsetting another deal that has dis savings in the first year. So, I don't.
Yeah. So if I could make a recommendation, and I'm gonna bump that up a little bit. So if we want to say 1% for each individual maturity, and then in aggregate, not to fall below 2% present value savings.
Okay.
I'm fine with that. So If we vote on
Are we
this,
talking about setting policy for future refunding?
I think it's just for this one refunding.
Oh, okay.
Yeah, you would have this same discussion for any
Unless-
other refunding opportunities. So you could change those criteria the next time around.
so what we'd be voting on is the, is the resolution to move forward with the refunding, subject to the criteria of no individual bond refunding would have an impact of less than 1% or savings of 1%, and that the entire issuance, for all the bonds included, needs to be 2% or greater, correct?
I think so, and because from a logistics standpoint, given that for the new issue, we're not forced to go into market, we're gonna look for a, sort of opportunistic, or maybe just stable is the right word.
Yeah.
Would we want to staple the refinancing transaction to that new one to shave off another?
Yeah, that's a good question. Don't these savings numbers assume that this is going to be stapled to the new bond issue? In which case
Well, my recommendation would be to do them together. This is on a standalone, what is presented to you is a standalone basis.
all right, so these savings could actually be better than what's shown. Well, depending on the rate
It
environment.
would be, yeah.
So Mark, on
Right.
page,
I mean, it would be,
Go ahead, Jim.
yeah, on page 12, like, we have two costs. 47 million of underwriter discount, which is basically just a percentage of what we're selling, correct?
Yep.
And then the 75,000, which is the other cost of issuance, which is like legal counsel and so forth. How much of that 75 do you think we could eliminate if we did this at the same time as a new issue?
well, they would, so that, and once again, so they're 45,000. I have not gotten into any discussions with him. He has a takedown here of $3.46. We haven't negotiated any of that. So just, especially if we're going to give them another 20 million on top of it, we're going to negotiate that for you.
Okay.
The cost of issuance for putting them both together, and then I have to talk to Marie and look at the rating agency, but let's, to get individually, they say they're 75. They're not going to be 150 combined. It's going to be, say, 100,000 combined, and then it's going to be prorated. So, 20 million, 20 million. So 13 million is going to be, 45%, right? I didn't do it, just doing off the top of my head. So of that 100,000, it's only going to be 45,000. Assuming my math is, it'll be prorated.
It's gonna be
based on
prorated against-
the total value. It'll be
against each
allocated
of the
towards
bonds.
the new money and the refunding.
So we would, by the notion of stapling it, would we do one issue of bonds with varied purposes? Or would we do two issuances of bonds together? How does that technically work?
Is it one OM, Mark, or two?
Yeah, it would be one series of bonds. We would break out the allocation.
Yeah, okay.
You'd have internal schedules, for
Yeah, okay. That,
budget
yeah.
purposes and all those
It'd
things.
be-
But for the market, I would think it would be best, and
It'd just
if
be,
we engage Piper, I would talk to
34
them
million
about them as well. I'm assuming they would probably want to have one series of bonds as well.
Okay. Are there any other questions
That's
for Mark?
how I'm envisioning it.
I have a question. So is the present writing, how we were writing this up, 100 basis points, has to be 100 basis points per tranche of bond? Has to be,
Well,
say-
we're not going to put all that in the resolution,
But
which is,
So here's my question, John, and Mark, this is, I think, for you. So if page 5 is the new bonds, page 15 is the old bonds, right? The yield so the yield, which starts at 81 basis points and goes to 95, you've said that this has moved up 50 basis points on average since February 10th? Does that sound about right? Or did I hear that incorrectly?
Yeah.
So if you add
Sure, that's
50,
correct.
if you add 50 across the board here roughly, so then you start getting a 130 in the bottom end, you get 145. And I'm assuming you then start comparing it to the interest rates on the old bonds that you're swapping out. If we use 100 basis points, you can't do it for the first tranche of 2021, you can't do it for the first tranche of 2022, first 2023, because they'll all be under that criteria.
I don't think the 100 basis points and 200 basis points that we're talking about, that's typically, that you don't, it's not 100 basis points of savings other than lowering your coupon from 2% to 1%. It's, if you look at the PV savings of that bond,
Okay.
so let's just say you save 100 basis points on the bond for 2 years. If you PV that back, that would be 2% of ignoring sort of PV, and you look at that as a percentage of par. So if you take $1 million bond and the present value savings on that is
Then we should change the language and not say.
$20,000, that would be 2% savings.
It,
Yeah, we're not talking about yield, you're not gonna get, if I heard the question correctly, we're not saying that the yield is gonna be below 1%. We're saying that the savings will not be below 1% for each individual maturity. Is that,
One more time?
and I don't know if you're gonna put that in the resolution.
The
I
net
think
present
that's
value
more of
savings
the
won't be any
designee will
less than
say,
1% for
hey,
the
where are we
individual
with the
maturity.
savings on these things? If that doesn't meet
2%
the
total.
criteria, take it out.
Yeah, we're not going to put this in the resolution. We'll use this as guidance that the three individuals, Jen, you, me, would assess or evaluate against the market conditions at that time. Good questions, though.
Because what if we're at 1.99999?
yeah, right.
Yeah, and
Something to think about.
in a moment of frivolity, I'll just say it's fine. Okay.
I guess the only other topic is negotiated versus competitive.
We also just need to confirm the structure, level principal versus, or level debt versus level principal, and do we want to do maximum deferral or first principal in
I think given the
12 months?
cost of all this, you're recommending we do maximum deferral, right, Jen?
Yeah, I mean, I think, and given the shape of our debt service in the next
Yeah.
36 months, you defer
Yeah,
the first
I-
principal payment to like, somewhere between the, it can't be later than 3 years, right, Jen?
Right, 36 months.
So somewhere between 2.5 and 3 years would be the
Max
first.
deferral is deferring the first principal payment.
Yeah. So I looked at the shape of those curves as well. I think that's a good idea.
And level debt, or, which we've done on the most recent issue, or level principal, which has been kind of our standard?
I mean, when you say level debt, you mean level debt service?
Yes.
So level debt service pushes out principal payment further. And I think Jim's point and his email, which I agree with, is we're in a historic interest rate environment, and I think we get more bang for our buck if we defer principal this time. Not our normal practice, but if you match that also up against the total debt service curve, it's slightly less painful to do this, which also makes sense. The other point I'd make is that this is the big bonding that we're having to do with the school and all. I'm not anticipating we're gonna have a lot more anytime soon. And if we do, it's gonna come further out on that debt service curve, and we'll have flexibility to take on new debt at that time.
So maximum deferral of the first principal and level debt service
That's my recommendation.
across the issue. Okay.
Is that all right? And then competitive versus negotiated, I actually don't have a point of view on that. Jim or Mark, maybe you guys can give us some guidance. What do you want to do?
I think my recommendation, just based on where the market is, or how the market is acting, it would be my recommendation to do a negotiated sale. It'll give us the greatest amount of flexibility. We have someone have a dedicated audience with the bonds, being able to market. I think it helps us be a little bit more nimble. If it was, if it was a normal market situation, I think we could, we can certainly do it all, both competitive, refunding and new money. But I just think in regards to where the market is, I think it might be to your best advantage to have a dedicated underwriter working on it. We looked at spreads for competitive sales versus negotiated sales. I think, once again, I have not negotiated this with them. Their average takedown is, for the refunding was 317, and yet expenses was roughly 350. Now, that's pretty cheap for an underwriter for uncompetitive sales. They're closer to $10 a bond, just because they don't necessarily have it all sold and marketed prior to purchasing them. So my recommendation would be go with a negotiated sale.
Is that something we have to decide at this meeting, or can that be decided at the last minute by the team that's doing this? Depending on the market conditions, or is it something we just do now?
Mark, what kind of time? We don't require your
Yeah.
board decision on that. Mark and I were looking for guidance on how you wanted us to proceed. So Mark, at what time do you need that determined?
If we're gonna, assuming we're gonna meet the April 13th timetable, I would engage them now, and they're gonna have to, their attorneys, and they're gonna have to, their counsel is gonna review the document.
Okay, I'm okay with the negotiated.
Yeah, I guess in terms of selecting the bank, how do we normally go about, or how do municipalities like this go about doing it in terms of like an RFP? Is it just sort of can the finance director individually choose a bank?
Yeah, so we, there's roughly three, and I apologize for the dog. There's three major players in the Connecticut market who participate in the competitive sale. So we kind of pre-vetted them, so to speak. There's Roosevelt and Cross, who you're probably all familiar with, who's done several deals for the town. Raymond James is one that's pretty active in Connecticut, and Piper, used to be Piper Jaffrey, now it's Piper Sandler. My recommendation beyond this would be Piper Sandler. They came to us, they have been following your bonds and looking at them. We have not heard from the other two at all, even when rates were so low. Maybe they were busy with other things or what have you. But that's who we would go with. If you want to do an RFP, we can certainly do it. That would just, it's going to take me, a few days, by the end of the week, get an RFP out and give them a week. It's going to slow the process down by at least 2 weeks.
So, Mark, absent, I think you said this just to make sure, absent kind of this extraordinary market volatility we're in, you would did I hear you that you would normally recommend a competitive deal?
I said no. I said we could have done it competitively with the refunding and putting in those benchmarks. It just adds a little bit more level of complexity. Typically we've done refundings, negotiated, and new money competitive.
Okay.
But since we're going to market, at the same time, I'm recommending we do it all negotiated. Can we do it competitive? We can certainly do it, but it just adds a level of complexity, and I think we might be better served by going negotiated on this one transaction.
Have we pursued transactions via negotiated in the past?
For refundings, yes.
And we've had favorable executions.
Yes.
Refundings are just tricky, I think, because the bankers are sitting with the desk trying to figure out what's happening with the curve, each tranche, trying to determine throwing a bond in, throwing it out. And it's a little bit more, I think, Mark, is it fair to say, kind of iterative with their sales forces and their marketing process?
Yeah, it's a little bit more, nuanced, exactly. And if we're going to tell them we can't, we need to have at least 1% savings for maturity, they're going to be doing multiple iterations. As you take a bond out, it can impact the next bond, and it becomes
Okay. All right, other questions for Mark? Okay. Hearing none, we've got a resolution to vote on, which Jennifer has here for the par value not to exceed $15 million, which would cover this refunding and then give the team the flexibility to decide whether to pursue it, and that we would do so based on the criteria that we discussed, which is 2% overall and 1% for any individual bond sale or bond refunding. Is that all correct, Jennifer?
Yes.
Okay, motion to approve. Paul, second. Dan, all in favor? Everybody on the phone okay with this?
Yes?
Okay,
Yep.
great. Okay, I appreciate all those comments. That's very helpful. So we have on the actual rest of the official agenda, continued discussion on the investment policy. We're going to defer that until later. On the budget discussion, the governor has issued guidelines that essentially delay decision-making on the 2020-2021 budget by 30 days. So what Jennifer did was to work up a new calendar based on what the governor's revised guidance provides for. And so that basically means that we do not need to do our budget discussions until later than what we had planned. So just give you a sense of things. Again, reading from Jennifer's note, the original date for the RTM approval for the budget was May 11th. So we delay that a month to June 10th. That means that the Board of Finance approved budget doesn't get published until late May 28th instead of April 30th. And then we don't have to turn over the budget to the town clerk until May 21st instead of April 21st. All this is a long-winded way of saying that we're just basically going to push back our budget discussions and deliberations by a month. That's going to do a couple things. One is gives us more time to work on the budgets ourselves, more time to collaborate with the RTM in terms of our review, more time to pose questions, but also hopefully gets us to a little further down the road where we can have more public discussions and maybe things have loosened up a bit in terms of being able to have discussions that are easily watched and easily participated in by the public. So we have a schedule that she has proposed to do that. I don't know if we need to go through that in much detail, but there's a calendar that she's offered up here that basically says the following. We're going to have this meeting today. Obviously, we're going to cancel 3 meetings that are scheduled that are budget work sessions. That'll be for March 24th, March 31st, and April 2nd. So our next meeting would be just a regular monthly meeting on Tuesday, April 14th. We would not set the mill rate at that meeting, obviously. And then right after that, we need to have our budget work sessions in early May. So she's proposing May 5th, May 7th, and May 12th. In my judgment, that gives us enough time to do our reviews and to be able to have a regular meeting on May 14th, which is a Thursday. And at that meeting, we would set the mill rate. And then from there, the process takes the budget that we approve, gets it publicized, and gets it into the hands of the RTN. If they can vote by June 10th, I think it is, then that is enough time for everything else that needs to happen.
Right, tax bills can go out on time.
All that. So I think I'm grateful for the relaxed guidance. I think Jennifer's done a great job to come up with a timetable that works for us. And I would offer that up for any questions. Anybody have any questions about that? Anybody on the phone? Okay. So we need a vote on this
Well, I
calendar.
was going to say, it gives
Go ahead,
us
Frank.
some option value. It gives us some option value just in terms of whether this environment would push us in different directions.
Right.
So this is good.
Oh, yeah. Option value is good.
Does deferring the calendar subject to anyone, to the RTM's vote as well, or do they live by our calendar?
So the language in the governor's executive order makes it sound like there is some legislative body approval to change the deadlines. The first selectman has reached out to our town council to say who is the required legislative body. She's hoping that it's Board of Selectmen. That'll be the easiest to convene and make the changes, but we are waiting to hear from Wayne on administratively what needs to be done. But we know that we can move them. It's just a matter of who has to formally bless it and pass it.
Yeah. My guess is that approval will be perfunctory. I don't think it's controversial, so we
Right.
should probably just go ahead and adjust the calendar as you've suggested here.
Right, so if we could just get a vote that you are approving the calendar as it is in front of you, and then I can file the notice of cancellations as well as the new meetings with the town clerk.
Okay.
And because we're more than 30 days out, these additional May meetings will be considered regular meetings, which will allow us to add to the agendas.
Okay. Other questions about the calendar? No? Okay. Motion to approve the calendar as revised by Jennifer, consistent with the governor's guidelines. Rob, second. Dan? All in favor? Okay, everybody on the phone okay with this?
Yep,
Great.
yep.
Okay. We've got one other thing, which shouldn't take long since we discussed it at the last meeting. It's not on the agenda. I think we need to have other business to put that on the agenda.
Yes.
So, motion to approve other business. Dan and Rob, all in favor? Okay, so our other business is to pick up a discussion we had at the last meeting, and this was about funding for the HVAC repairs and renovations that we need to undertake at the police department. You'll recall that discussion was, the chief was here, Ed Gentile was here, and that whole discussion was about pretty serious deficiencies in those systems, requiring a fair bit of work to replace them. Jennifer, can you remind me what the dollar amount was on that? I think I've got it.
$233,429.
Yeah, here it is, sorry. $233,429. We talked about this at the last meeting, and we approved this to go to the RTM, but because the RTM's meeting was canceled last night, we want to consider moving this forward so that work can get done in time for the summer season. So the proposal is that instead of having a contribution from fund balance, which would require an appropriation for the RTM, we're going to instead approve the motion that we would take this from the Board of Finance reserve and pay for it directly. Somebody had asked before as to whether we would do that from fund balance or from this reserve. The difference is that this is appropriated, so we can make the decision and we're done. Whereas fund balance actually has to go to the RTM for an appropriation, and that kind of defeats the purpose. So I'm okay with this. Jack Davis is aware of it, and I know F&B as well as 2 or 3 other committees. There's a video out on this that you can watch. They deliberated it, and they are comfortable with us taking this action so that this work is not delayed. So no change from the last meeting, except that we're going to take it out of the Board of Finance reserve. Any questions about this? Anybody on the phone have any questions about this? Jennifer, anything else to add?
Nope.
No,
Okay, motion to approve the revised resolution we had at the revised resolution we had at the last meeting, which is to take the $233,429 out of Board of Finance reserve so that this work can continue or get underway immediately. Motion to approve. Jim? Second, Paul? Okay, all in favor? 5-0. Everybody on the phone okay with it? Oh, take that as, okay, good deal. Okay, I think that is it for our agenda.
One question.
Dan, a question, please.
We've received questions both in emails and in public regarding monies authorized to be spent, capital monies authorized to be spent in prior fiscal years, or in our current fiscal year. Are those types of things able to be revisited given circumstances that we find ourselves in, or is that business that's been conducted and we are now past any conversation around those types of expenditures?
Yes, it's a good question. I think what needs to happen is there needs to be a general sense of seriousness, right? So if we, as a town, need to start taking serious action to respond to all of this crisis, and that action is on multiple dimensions. The first selectman's already declared a town emergency, and there's different things that are going to happen as a result of that. There's going to be a lot of town-wide efforts to support our small businesses. That's one thing. If we decide that as a financial matter, the town is starting to get into trouble, and that could be in terms of tax collections, it could be in terms of liquidity, it could be on a number of dimensions like that. I think we need to start to have active discussions about what, if anything, we need to do either as a town collectively, in which case we'd recommend it to our town official colleagues, or as a Board of Finance individually. To be honest, in this particular crisis, I'm not sure how the power to do all of that actually splits up among the various town bodies, and whether it's Board of Selectmen, Board of Education, or if it's us, or if it's the RTM that needs to come together and take collective action. I think it's premature maybe to start to pick at certain things and say, well, it's simply a matter of prudence, we're going to go after a particular level of, or a particular project or a particular expenditure just because it's feeling like now's the time to be prudent. What I'd rather do is have a discussion once we get to a level of seriousness that really dictates that in order to protect the town and our citizens from an unfolding problem or worse, catastrophe, then we need to start taking action in that way. But that's my general view. Now, Jennifer, you have anything to add to that?
No, I do not.
Okay. Other comments or questions? Okay. I don't have anything else to add. I think I said my piece at the beginning, but nothing further. So just to confirm, our next meeting will be on Tuesday, April 14th. We'll get the new calendar published. The only thing I'll add there is I'll come up with some individual topics to cover in the new revised schedule for the May sessions. So I'll send that around to everybody. If your schedule is such that you either can't be ready by those dates or you won't be here for those meeting dates, let me know and we'll move things around. But I'll get that out hopefully this weekend. That's it for me. Motion to adjourn. Paul and Jim. Okay. Motion to adjourn? Are all in favor? Great. We are adjourned. Thanks to everybody on the phone and TV 79 for working with us tonight, and be safe.